Hey guys, Jorge Rivera, Simple Lending Mortgage. In this video, I want to talk to you about lender overlays. This is inside talk. You probably are not aware of what this is. Realtors are probably not aware of what this is. This is why I'm making this video, because this stuff matters. So I'm going to break this down to you. What is lender overlays? Lender overlays means that the lender has taken the written guidelines from the loan program and have added additional restrictions or additional guidelines above what the program actually requires. For instance, with VA, did you know that VA does not have a Fico requirement? Oh wait, you didn't, right? VA actually leaves it up to the lender to make the determination, because VA doesn't do loans directly. I know a lot of you things, Veteran United, Navy Fed, USAA, all of these VA-friendly term lenders are actually somehow affiliated with VA, but there is no affiliation with VA. VA is actually its own thing, Veteran Administration, and they actually insure the loan, but they don't do the loan. The lender does. So what the lenders do is that in order to mitigate risk, they add these overlays. What these overlays are is probably the reason why a lot of you have been denied by these programs, and you are made to believe that you cannot buy a house today. For instance, we just talked about how VA has no FICO requirements. However, I have not yet found any lender that can do a VA loan under 500 FICO. That seems to be where the most aggressive lenders decided, but there is a reason, because even though VA has no FICO requirements, they do have a credit history requirement. And I think the most aggressive lenders have realized that if you actually go under 500, you are hitting some marks, I guess you could say statistically, where you're just not going to qualify, and that's where they draw the line. For instance, you probably heard of some of these veteran-friendly banks that have told you you need a 640 or above to qualify, and we just said that that's not the case. There's a lot of VA-friendly lenders that will say you need a 620. That is also not the case. Let's go into FHA. FHA, the same thing. Some banks will actually won't touch you if you're under 640 for any of loan programs, and some will say they'll come down to 620, but again, still not the case, because FHA can actually go down to a 580 FICO. The black and white is not on the credit score, but it is on the credit history, and that's where I guess the catch-22 comes in, because you can be as low as a 580 for a 3.5% down. However, you got to meet the credit history requirement, which if your credit score is that low, chances are there are reasons for it that will keep you on the credit history side from qualifying. But again, I've done those, so that's not necessarily true. Now, FHA can go down to 500, 550, but once you go under 580, you are required to do a 10% down. That does get a little trickier because of the credit history requirements. But again, this is not about how the loan part of how that goes. I'll do another video later for that. I just want to address the fact that this is a lender overlay that you have been hearing, that you need to have a 620 or a 640 to qualify, when with VA and FHA, that is not the case. Now, conventional actually starts at 620. That is across the board. There is no overlay. Well, take that back, because some banks actually want you to have 640 or above, when you can actually get a conventional with a 620 and above. Now, again, their credit history requirements are there. This is the part that's never really explained, because you're always being turned down based on your credit score, or where they talk about the credit history. What I get a lot of the time with my second opinion service is that they won't explain fully what about the credit history was keeping them from qualifying, and I usually provide them with a roadmap of what exactly we need to overcome so that we can then enter the pre-qualification window. 45% debt to income ratio, DTI. A lot of lenders actually have overlays on that. When they calculate your debt to your income and they do the percentage, they don't really want you to go over 45. Now, while that may be true with conventional, and that is very dependent on the down payment, the credit score, how much money's in the bank from the borrower by. That's not necessarily a hard rule, because with VA, I've actually gone over 50. With FHA, I've gone up to 53. So again, this does matter, because believe it or not, the difference between 45 and 53 can be thousands, and those thousands can translate into the type of house you're buying, the neighborhood the house is in. So it does matter. Think about that. It opens up actually more purchasing power when you deal with a lender that has no overlays. Some of the deals that I've actually came through, especially for a lot of in the veteran market, they want 2 years on the same job. And again, that is an overlay, because the requirement for whether it's Fannie, Freddie, FHA, VA, USDA, they want a 2-year work history, not 2 years at the same job. Now that holds true if you're, now okay, let me take it back. So if you're W-2 paid, 2-year work history. If you're self-employed or 1099, then they really want you to have 2 years and that line, because your income is calculated on 2-year tax returns. But that is a self-employed rule. However, I've come across W-2 paid employees that have been asked to be 2 years at the same job. W-2 paid employees only need to have a 2-year work history. Unless you're trying to calculate into the income, bonuses, overtime, commissions, then you got to have 2 years of bonuses, overtime, and commissions. But it doesn't even necessarily have to be the same job. We have done loans where somebody worked for this car dealer and moved to the competition car dealer, and it had only been 3 months, but because they have been in the same line of work for over 2 years, we can do a 2-year average of the commissions, the bonuses, and the overtime. We just have to show that those incomes have been present and stable for 2 years. But again, we're talking about the overlay that they require you to be 2 years at the same job. That is not accurate. That is actually an overlay. Medical collections. I've had customers that when they come to me and I get them pre-qualified, their funds have been depleted because they paid off medical collections. Again, this is a combination of overlay mess ups here, because what happens is they're trying to get you to a 640. So in order to get your credit up, they want you to pay your medical collections so your credit can go up. But now here you have depleted your money paying off all these medical collections, when in reality, the credit score you had before you paid them off, I could have already gotten you into a loan. So now you're out of money. Your credit score didn't go up the way you intended, because a lot of loan officers want to play credit repair. Now, if you have experience the way you've been dealing with actually financing and credit long enough where you actually know your way around, I guess you could say Fico, but God knows everybody knows, nobody understands Fico. But again, medical collections, I've had some where they require you to pay it off. Actually, if you look at FHA and VA, medical collections can be omitted because they're not required to be paid off. So yes, medical collections, because it is a collection, it affects your FICO score. Now, there is nothing the lender can do about your FICO score, because that was already determined by FICO because you got hit with a collection. But if your FICO score is still good enough to do the loan, we can bypass the medical collection and not require you to pay it off, and save you that money that you would need for your down payment and closing costs. Bankruptcy. We just did a loan that actually the customer was Chapter 13. They were on payments to the trustee, and they had 3 lenders that had turned them down because they were still under Chapter 13 bankruptcy. Again, either it was an overlay or a misunderstanding of the rule. Because when you do, for instance, FHA clearly stipulates, now actually FHA, because conventional is very hard on the bankruptcy requirements and the years of wait out. But with, for instance, FHA, if you have done Chapter 7, they just want you to wait 2 years. If you have done Chapter 13, as long as you have made on-time payments to your trustee on time, if everything else qualifies with your FICO scores and the credit history and everything, you can still get the loan. We just need the permission from the trustee and the proof that you have made these payments on time. So again, these overlays are majority of the reason why people are being told that they do not qualify. Now, what is insulting here is that most of these lenders, they know there are competitors out there that can do this loan for you. But what they do instead is pigeonhole you into working on your credit, spending money unnecessarily, telling you the reasons why they can't do the loan, but not telling you how you could still move forward getting the loan. And then you obviously exasperated because you have tried every option, no one is giving you this financing, and you give up. And in this market, don't give up, because there are options. Actually, I'm going to tell you what, as a broker, I actually have 20 plus lenders at my disposal. Out of some of the lenders that I have, some of them do have overlays, and that is okay. That is why I'm a broker, so I can have more options for you. Because if I have a lender that because of an overlay, I can't take you there, I have other options. And I have lenders that have 0 overlay. Let me just kind of put this in a more layman's term. You know when you go to buy a car, right? You know why the reason the dealer, when they send you to do the financing and they take your application and they throw it to like 20 different banks and you get 20 different inquiries. But what they're really looking for is to make sure that they improve their chances of getting you qualified. And after they get you qualified, they go over it with you to show you which was the best terms that they got you qualified with. Now, because the dealer is actually not working or contracted directly with these banks and lenders, they have to send this request independently, and every bank and lender has to pull your credit, which is why you get 20 plus credit hits in your inquiry. However, when you deal with a mortgage broker, we are actually contracted, signed up with these lenders. I am a licensed loan originator, so I pull your credit. So when you apply with me, it is one application, one credit pull, and I run that through my 20 plus lenders, and I see who I can get you qualified with, who gives you the best terms, the lowest rate, the lowest cost for originating, and I propose to you my best offer. So when you come to a broker, you are doing one application, but you're throwing it basically against the top lenders in the nation, considering if you went to a bank or you went to a lender, you are playing their one option. And you are getting what they can do. And they're going to tell you if they can't do it. And they're going to tell you to move on and make room for the next one. You have another one that will try to make it work with you. And they'll have you pay this off and pay that off and get this and get that. 3-4 months later, it didn't work out to your favor. And that's 3-4 months later that you either exhausted funds that you could have used otherwise somewhere else. At the end of the day, you wasted time in today's market. The house you loved, you fell in love with today, was under contract already yesterday. So when you deal with the broker, the benefits to you is that you're putting a system to work for you where you're rate shopping at one stop. And again, I am not telling you in any way or another that you should not rate shop me. By all means, I feel so confident with what we offer here at Simple Lending Mortgage that we want you to know that you're getting the best deal. But we also want you to know the difference between a bank and between a lender, because they're only going to offer you what they have. I'm going to offer you what's at my disposal, which is over 20 of the nation's top lenders. And I do have lenders with overlays, but I also have lenders with no overlays. So that one stop is going to get you the answer that you're looking for. And listen, if I can help you because for any reason we don't meet the criteria. Maybe we don't have the credit score. Maybe we don't have the credit history. Maybe we don't have the cash that is needed. But we're going to provide you with what is needed to have the entry point with the most aggressive lender at our disposal. So we're not going to tell you how much work you have to do to get with this bank. We're going to get you to work with a lender that can work with that. So that is the difference. And this is why overlays matter. And this is the part that no one talks about because this is trade talk. But I wanted to bring that out to you because this is the biggest factor that we're seeing in today's market that is putting a lot of buyers out of the race because they're being told they don't qualify and they're being given unrealistic expectations and an unrealistic task of what needs to be done to qualify. And I have been able to assist families that didn't have 2 years at the same job, that had medical collections, that were in Chapter 13 bankruptcy, that were over 45 DTI, and they were under 620 FICO. This is Jorge Rivera with Simple Lending Mortgage. If you have any questions, please drop a comment below. Let me know. I mean, I don't know everything, but I do research everything. Thank you.